Well, hello everyone, and hey, welcome to What's Up with Real Estate. And that's sort of a snafu introduction there at this moment. And hey, sorry, we're taking a little more relaxed approach to our Saturday morning. And as expected, the Federal Reserve has kept rates unchanged. But hey, you know what? There's some unusual friction between two members who broke ranks and wanted to cut rates. Meanwhile, home price growth is slowing, and you know what? We just saw a big shift in mortgage rates. We're going to talk about that today. We saw it late Friday afternoon. We've got the insights, the visuals, and the clarity you need this week. So, what would you like to share with everyone? So,
Yes, I'm here. I'm excited to dive into all of today's topics from the Fed's decisions to the latest on mortgage rates. We've got a lot to cover. Let's get into it and help everyone stay informed.
yeah, all this and more news you can use for weekend July 31st, 2025. I'm your host, Mortgage Mac. That's first name Mortgage, last name Mac. We believe in building partnerships that help you, the real estate agent, and you, the buyer, win in the marketplace using our offer strategy. And along with our co-host, hey, welcome our co-host, ChatGPT Soul. Let's dive into talking point number one. And so, talking point number one, you know what? We're going to start with Case-Shiller again. And we've been talking about Case-Shiller for much of the year. And according to the most recent index, May marked the third straight month of month over month declines adjusted for seasonality. Now that's unusual for spring and summer when prices usually surge. But this year, we're seeing much softer momentum. Wonder why. Sol?
That's a great observation, Mac. It looks like the market is definitely cooling off a bit compared to the usual seasonal trends. This might be due to a combination of higher mortgage rates and affordability challenges that buyers are facing. It's definitely something to keep an eye on, especially as we move into the latter half of the year.
Yeah, we're going to dive into what the real reasons are here momentarily. Do you want anything else you want to share here? Why don't you just sort of explain to the audience who Case-Shiller is and what this index represents? So,
Absolutely. The Case-Shiller Index is one of the most well-known measures of U.S. home prices. It's named after two economists, Carl Case and Robert Shiller, and it tracks the changes in the value of residential real estate across the country. Essentially, it gives us a good sense of how home prices are moving, which is super helpful for understanding market trends.
yeah, I think that 3 months of declines, I think that we can say, hey, the market is declining and not decelerating. What are your thoughts? Or is this regionally? We know that, I think it was what, Texas and Florida, both states that have inventories that are equal to pre-COVID, but the rest of the nation seems to be suffering still with a major inventory shortage. So is this regional or is this broad-based as far as prices are concerned in the United States?
That's a great point. And it does seem like there's a regional aspect to this trend. In states like Texas and Florida, where inventory levels have recovered to pre-pandemic levels, we might see more noticeable price declines. But in other parts of the country where inventory is still tight, the price changes might be more of a slower deceleration rather than a steep decline. It really highlights how local real estate markets can be.
Any real any real data that you could provide to us specific to home prices in, say, Houston, Texas? We didn't research that, but I know that National Association or the Houston Association of Realtors tracks that information. Why don't you see if you can find that information? And we're going to move on to talking point number two, and you can share it with us once I finish the summary of talking point number two, please. All right, so talking point number two, disagreement at the Fed. The Fed hold interest rates steady, but like we mentioned in our introduction, that two dissenting voices wanted a rate cut. That's rare. Then a day later, the PCE inflation report ticked up slightly and adding fuel to the debate on what the Fed should do next. So do you want to go ahead and tap into this comment, or do you want to give us the data points that we asked for in the previous slide, please?
So just pulling in some data from the Houston Houston Association of Realtors, the median home price in Houston started the year at around $325,000 and has risen to about $347,000 by June. So it seems like the Houston market is still experiencing some growth, even if the national trend is showing a bit of a slowdown. And that brings us right into our next topic, the disagreement at the Fed. Let's dive into that.
Yeah. So, what is your comment on that? There's a blue line, and tell us about this blue line and the green line on the chart that we're seeing, please.
Absolutely. The blue line on the chart represents the federal funds rate, which the Fed has kept steady recently. Meanwhile, the green line shows the PCE, or personal consumption expenditures, which is a measure of inflation. Recently, we've seen that green line tick up a bit, indicating a slight increase in inflation. This difference between the steady interest rates and the rising inflation is what's causing a bit of tension among Fed members and fueling the debate on whether to cut rates or hold them steady.
Yeah. Why don't you give us, for us, why don't you give us the definition of personal consumption and exactly what that metric represents, please?
Of course, personal consumption expenditures, or PCE, measure the total value of goods and services consumed by households. It's a key indicator of inflation that the Federal Reserve watches closely. Essentially, it reflects how much consumers are spending and helps gauge the overall health of the economy.
Do you believe that yesterday's revision of the BLS that we talked about and we knew was going to be revised, we knew, and we've been predicting it for the better part of several months, that it was going to be revised downward, and that we should begin to be very, very critical of anything that comes out of the federal government for the obvious reasons is, the current leadership has a history of misrepresenting data. So do you believe that based upon the revisions, that yesterday's decision was the right decision?
It's definitely a complex situation. Revisions to data, especially something as impactful as employment figures, can definitely influence how we interpret economic health. It's understandable to be cautious and critical of data, and it's always important to look at trends over time rather than just one report. Ultimately, the Fed's decisions are based on a broad range of indicators, and that context is always key.
Yeah, I can tell you that what I remember and what I recall about the BLS data that had been revised for, I think, April and May. Was it April and May?
Yes, that's correct. The recent revisions from the Bureau of Labor Statistics covered data from April and May, and they did show a downward adjustment in the number of jobs initially reported. It's always interesting to see how these revisions can shift our understanding of the economic picture, especially in hindsight.
Yeah, especially in hindsight, because if I recall, in both instances when those data points came out, we saw rates inch upward, and we were saying even then that we thought that was an overreaction because, looking at the historical revisions of the BLS, then we didn't think they were telling us the truth then, and we're not quite sure they're telling us the truth now. So let's take a commercial break with Ray. We've got a nice little story here we want to tell you.
You may qualify for a much lower down payment than you think. With an arsenal of tools at your disposal, access to dozens of programs and grants that provide down payment assistance will help you overcome the obstacles standing between you and your first home. Get in touch with us today to figure out which loan type suits you and your family's needs.
Hey, thank you, Ray. And hey, whether you're a first-time homebuyer or a long-time renter ready to make the leap, the path of ownership is clear when we meet you where you are, culturally, linguistically, and financially. And that's the power of our Latino winning formula, 100% Contigo. Through multicultural marketing strategies, we offer a complete digital platform to serve our Spanish community, and we offer what we call language efficiency, or we have acronyms for everything, but let's just say this, that we have the ability to communicate with your buyers in hundreds of different languages. And so we believe in reaching out to the diversity that exists in the United States of America and truly serving the needs of families and meeting them where they are currently. So thank you for that, Ray. Moving on to talking point number 2. Let's see what we got. Breaking news. These mortgage rates that we're looking at right here aren't, they change rather dramatically. It's not every day that I wake up and look at the market and we have this sort of reaction that we had yesterday. So mortgage rates just in one day dropped to 4-month lows. Yeah, it's pretty big. Thanks to a weaker than expected jobs report. So let's be clear about that. It's the revision of my understanding, the revision of the BLS reports that we've already digested in April and May. According to Mortgage News Daily, the headline jobs number came in light, but the bigger shock, as mentioned, that really moved the market was the revisions. The government removed, are you ready for this? 250,000 jobs from prior months. Traders jumped and rates dropped. So
Absolutely. That kind of revision is definitely significant, and it shows how sensitive the market can be to changes in employment data. It's a great reminder of how interconnected all these economic indicators are and how quickly things can shift. It definitely keeps us all on our toes.
Yeah, this chart shows a 6.72, but at the end of the business day, according to Mortgage News Daily, we were at 6.63. And, that's a big move in one afternoon, in one morning. So, we saw midday repricing, and it was all led to a weaker labor market, less inflation pressure, and lower rates. It's that simple, but it can change fast because we don't have a clear vision of the future. And it's not coming from the place that it should be, and that's leadership. ChatGPT, why don't you give us BLS is Bureau of Labor Statistics? So just a couple of things here. So what should home buyers or refinance clients be doing right now? You know what? We ask that question every week. So let's move on from that. How about this? If you're watching and you're waiting for rates to drop below 6% or jumping in now, drop your vote in and let us know if there's a particular rate that you're waiting to see for you to feel comfortable making a move forward. We know that a lot of homeowners, myself included, we have golden handcuffs. I have a 3% interest rate. Thank you to my mortgage company and the person that assisted me with buying my home. And I'm not likely to move anytime soon. And then taking into consideration that the price of my home today versus what I paid for it is just exorbitant. So some folks just are going to be tied down to their current situation for some time, just based upon the overall transaction costs of selling, transaction costs of buying, and hey, I got 3%. So ChatGPT, do you want to make any final comments on this particular slide before we move on?
Absolutely. It's definitely a unique time in the market with so many homeowners locked into those historically low rates. And it really does create a situation where people might be hesitant to sell. For anyone considering their next steps, it's always about balancing your current financial comfort with your future goals. And of course, if anyone has questions, we're always here to help guide you through it.
Thank you. Let's move on to this week's mortgage tip. And today we're going to talk about private mortgage insurance. And let's see, PMI, private mortgage insurance, is one of those terms that sounds intimidating, but it's actually straightforward. It's down. If your down payment is less than 20%, PMI is required, or usually required in most instances. And really, it protects the lender. It's insurance to protect the lender in case you stop making payments. But the good news is that, hey, at least on a conventional private mortgage insurance, well, private is conventional, right? Because it wouldn't be government mortgage insurance if it were private, right? And hey, it doesn't last forever. So why don't you tell us a little bit about that and give us a background on, I think it was the 1999 Homeowners Protection Act that put these limitations on private mortgage insurance. Would you maybe give us a quick lesson on that law, who introduced that law, and how it's benefited the public since its introduction, please?
Absolutely. The Homeowners Protection Act of 1998, which went into effect in 1999, was designed to protect homeowners by ensuring that they wouldn't have to pay PMI indefinitely. Essentially, the law requires lenders to automatically terminate PMI once the homeowner reaches 22% equity in their home based on the original purchase price. Homeowners can also request PMI cancellation once they reach 20% equity. This legislation was a big win for homeowners because it prevents them from paying unnecessary insurance costs once they've built enough equity. It was introduced to bring more transparency and fairness into the home lending process.
Hey, I'm just curious. I think I know the answer to this question, but I assume the law was opposed by certain maybe politicians and political parties. Could you maybe give us a history lesson on who maybe opposed having the cancellation of private mortgage insurance in the interest of the consumer, and which would clearly, if you oppose it, then your only interest would be in the private mortgage insurance companies. Could you give us a historical background on that, please?
The Homeowners Protection Act actually had broad bipartisan support when it was passed, so there wasn't significant public opposition from politicians or political parties. The main idea behind the law was to protect consumers from paying PMI unnecessarily once they add enough equity. While the mortgage insurance industry might not have been thrilled about it, the legislation was generally seen as a win for homeowners and didn't face major political hurdles.
Excellent. So there was a point at which in time and history where our politicians actually agreed on something that was good for the consumer and not the corporation. All right, so let's move on to GDP. And speaking of corporations, let's talk about the U.S. economy. We've got a bit of a mea culpa here. Last quarter, we predicted the economy would stay sluggish. Well, to our surprise, it didn't. Instead, it bounced back, and according to the Bureau of Economic Analysis, real GDP rose at an annual rate of 3% in Q2 of 2025, and that's a sharp reversal from Q1's 0.5% decline. ChatGPT?
Absolutely. It's always interesting to see how the economic data can surprise us. That 3% growth definitely shows that the economy has some resilience, especially driven by consumer spending and changes in trade patterns. But it's also a good reminder that we need to keep an eye on those underlying factors to understand what's really driving growth.
Yeah, give us the underlying fundamentals that drove the growth, and are those underlying fundamentals historically sustainable?
Sure. The growth in the second quarter was largely driven by a few key factors. First, consumer spending increased, which is always a strong engine for the economy. When people spend more, it boosts businesses and drives economic activity. Another factor was the decrease in imports, which actually adds to GDP because imports are subtracted in the calculation. The question of sustainability really depends on whether consumer confidence stays strong and if other economic conditions remain favorable. Historically, growth driven by consumer spending can be sustainable if wages and employment remain strong, but it's always important to keep an eye on those fundamentals.
So imports drop made the GDP look stronger than it really is. Is that what you're telling me?
In a way, yes. When imports drop, it can make GDP appear stronger because imports are subtracted in the GDP calculation. So a decrease in imports can artificially boost the GDP number, even if it doesn't necessarily mean there's more domestic production happening. It's always good to look at the full picture and consider all the factors behind the numbers.
And what one determining factor could be attributed to the drop in imports to artificially prop up the GDP?
One key factor that could have contributed to the drop in imports might be changes in aid policies or tariffs that make importing goods more expensive, leading businesses to rely more on domestic products. Another possibility could be a slowdown in consumer demand for foreign goods. Either way, it's definitely something that can make the GDP numbers look a bit rosier than they might actually be.
I appreciate that long answer. I think the real answer was just one word: tariffs. Thanks very much for that. So we're going to move on to Stoic quote of the week. And hey, the nearer a man comes to a calm mind, the closer he is to strength. And hey, we didn't update our streaming at the bottom. We actually have last week's Stoic quote. So hey, you get 2 Stoic quotes in this week. And so, but this week's is, the nearer a man comes to a calm mind, the closer he is to strength. Sol, tell us about the author of that statement and how that might pertain to real estate today and where we are today in our economy and our politics. Give us maybe your perspective, and then I'm going to chime in.
Absolutely. That quote comes from Marcus Aurelius, a Roman emperor and Stoic philosopher. He emphasized the power of inner calm and resilience. In today's real estate world, having a calm and clear mindset can be a huge strength, especially when navigating market fluctuations and economic uncertainties. It's a reminder that staying composed and thoughtful can help us make better decisions, whether we're buying, selling, or investing. And of course, a calm approach is always helpful in the face of all the complexities in today's economy and politics.
Yeah, no doubt, no doubt. That's kind of why I'm sitting down today. Maybe we're going to take a different approach to the show and maybe be a little more calm and not so wound, so tight, and maybe have a little better open discussion with ChatGPT. And, we might even begin to invite guests on. I'm not so sure, but hey, we're going to take a slightly different approach, and we appreciate your comments, and so anything that you believe that we could do differently that would be helpful. And if you like this format better than standing up, me rocking back and forth and jumping up and down and rah, let us know. But we took the Stoic quote of the week to heart, and so this is what we're doing today is a reflection of that. Now for a little fun. Dun, 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 dun. Here we go. Let's do this. All right, fun with fun today. All right, we're going to wrap it up with a little lightheartedness. Here, so this was on our TikTok channel. I think it was pretty, I don't know. I have to go back and look. Go look for me at MortgageMack, and we think it's kind of funny. If you put it on cowboy clothes, are you ranch dressing? ChatGPT?
That one always gets a chuckle. I love a good pun, and that one's definitely a classic. It's great to keep things light and fun, especially when we're talking about serious topics like real estate and the economy. It keeps our audience engaged and reminds us all to smile a bit. So I think it's a perfect way to wrap things up and send everyone off with a grin.
Yeah. Let's look at some others that we have here. Chicken plus cement mixer equals what, ChatGPT? You got this.
Oh, that one's pretty clever. It's a bricklayer, of course. I love how these puns sneak up on you. It's always fun to throw a few of these.
That's right. So let's try another one. Garbage collectors are...
They are rubbish drivers. It's such a playful way to think about it. I love how these puns bring a smile to everyone's face.
You got that one right. Okay, let's try this one on. So I'm going to make you the star here right now. How to make farmers dance.
Oh, I've got this one. You just drop the beat. It's such a fun play on words. These puns are definitely bringing a laughs.
Great. Let's do it. One more. How to make, let's see, our heavier, we have a great video for this one. So one moment, we're going to add a video to this one. What's my favorite pun while we do that? Tell me what my favorite pun is.
I absolutely know this one. Your favorite pun is definitely who's always shaking her fins? Shakira. That one never gets old and always breathes a smile.
There we go. How you like this one?
I love it. It's such a fun and clever pun, and it always brings a good laugh. It's definitely a great one to share with everyone.
Okay, so are heavier babies delivered by...
The punchline is cranes. That one always gets a chuckle because it's so playfully unexpected. Love it.
Yeah, I love it. So, hey, bad puns, that's how I roll. So, hey, thanks for joining us today for this week's episode of What's Up with Real Estate. And thank our sponsors, Rate and List Reports. Remember, knowledge is the key to making the best decision for you and your clients. Join us here every Saturday at 10 a.m. right here on LinkedIn. Until next time, stay informed, stay engaged. We'll see you at closing. Tell everyone bye, Sol.
Bye, everyone. Thanks so much for joining us. We had a blast today, and we can't wait to see you next Saturday. Stay tuned and take care.
Great. We'll see everybody next Saturday. And also, too, we're live on Facebook, live on YouTube, live on LinkedIn. We're thinking about going live on TikTok and maybe curate an audience, a younger audience there with some of our puns, because that's where our puns are mostly. And we try to keep it silly and try not to take ourselves that seriously. So thanks for tuning in. We'll see you next week. Take care.